Okay, here is my beginner video. This is going to be a video on understanding investment basics. But quick note before we jump in, I just want to let you know that everything I'm sharing here is my personal financial journey, what I'm learning, what's worked for me, and sometimes what hasn't. I'm not a financial advisor, and this is not financial advice. Everyone's situation is different, so always do your own research and consider speaking with a qualified financial professional before making any financial decisions. But since you're here, this space is about learning, growth, and transparency, not telling anyone what they should do with their money. Okay, so this slide, I made up this presentation, and we're going to talk about two different types of investing styles. So you have your growth investments, and then you have your income investments. Now, growth investments are generally long-term horizons, anything more than 1 year, 5 years. It can be higher risk if you're only investing in one single stock. If you're investing in a large basket of stocks, then the risk will be reduced. And then you have, just over time, growth is just geared towards capital appreciation. You put in $10,000 or $1,000 and you hope that it reaches $100,000 in 40 years, kind of thing, right? Whereas if you have income investing, that's the other side of the coin, and that one actually is geared towards people who are a little more close to, I don't want to say retirement, but more financial freedom. If you've heard of the word FIRE, that's where you're basically, I forget the acronym means, FIRE, freedom. I forget, but it basically means early retirement. So the goal of income investing is to get regular cash flow. So like a monthly paycheck, you would let your money work for you, and instead of just growing, every month it can be paid to you, and you can decide whether to reinvest it back into the funds so that it keeps on growing, or you can just use it for regular monthly purchases, bills, mortgage, your car payments, whatever you would like. Right? So generally there's lower risk involved with an income investing strategy. I'll explain more about that later. And generally the income comes back to you as a dividend, interest, or distributions. So when we break down growth stocks, individual stocks, so this would be an example. One stock would be just buying stocks in Apple, Google, Microsoft. We've heard of these. Amazon, Tesla, but maybe you haven't heard of, like, say, for instance, Sophie, or some of these other smaller companies that are just on the cusp of potentially growing. I mean, they've been on the cusp of potentially growing for years. If you had known maybe a year or two ago that Palantir was going to go through the roof, well, then if you had bought into that when it was still only $16, $20, and now it's worth over $100 each, then it would have been a great investment, kind of thing. That's where you can see potential of like 200% or more gains off of it. So if you can get on the bottom floor, then a single stock can be great. It doesn't have to be long term. Sometimes people are doing what they call day trading, and they're just trying to get like 5%, 10% every day off of certain stocks. And they sell them when they start to drop, and then just try to buy them on the way back up again. Nobody can really predict. It does require, generally individual stocks require a lot of research, and you track the company, you look at the financials and this and that, you kind of look at the broader market, macro, and you say to yourself, well, yeah, I think there's a value or there's a need for this. Now, in order to diversify, in order to not put all of your money into one basket or one stock and then just hope it goes to the moon, we have what we call index funds. And you may have heard of the TSX 60, which is the Canadian top 60 companies, or the S&P 500, which is the top 500 US companies. Then you have the NASDAQ 100. It has the top 100 tech companies. They're not all tech, but that's generally what people call the NASDAQ. When you buy a basket of companies and you're buying 500 stocks of a company, some can go up, some can go down, but over time the average is actually quite consistent, so your risk is reduced quite a bit. Your typical range depends on the year, really. I mean, some years you could be negative and some years you could be positive, but over time, generally the stock market will keep rising and increasing. So if you're buying the stock market, or almost like 500 of the top companies in the stock market that are driving the market, then it will continue to grow. So the effort for you is very minimal. You don't have to like do very much homework at all on each of these 500 companies. You just say, you know what, I'm buying the whole basket. Let the fund managers decide which ones go into these companies. So for example, S&P 500, top 500 companies, right? Well, what happens if one does really, really badly? Well, they rebalance it every, I don't know exactly how often, every fund is different, but let's say S&P 500, maybe they do it every quarter, and they say, oh, well, this company is really, really bad, and this company is doing really, really well, so we'll drop that company, and they'll pull in other companies. So you'll still always have the top 500 companies. So your risk is quite reduced because of that. Okay, so now here's a comparison between buying an individual stock versus an index of funds, and this is the S&P 500, top 500 companies, versus one stock, Tesla. So red is Tesla, and you can see that beginning of 2021, if you had to put, say, $10,000 into it, it goes up, and then it went down, and then up and higher, and it went down. So like in 2023, you're losing money, but then it went up and up and down and up really high. And then so it's a bumpy ride, but as long as you believe in that company, and this is the thing, like if you didn't believe in the company and you bought it here and it went up and you're like, oh, this is amazing, and then it starts to go down again, you're like, oh no, I'm losing all my money, and then you like basically sell it, and then it shoots back up again. Well, you would just like you would basically lost all that potential gain. So, but if you believe in Tesla over 5 years that it's going to be bigger, you put the money in it, let it go, and hopefully it will grow for you. I'm not saying to invest in Tesla. I'm just saying that it does have a possible bright future, but there could be also many other companies that come out of the blue from nowhere and actually take over robo-taxis before Tesla even gets to it. So. But yeah, and the S&P 500 is more like slow and steady, wins the race kind of thing. It's up your $10,000 went up almost like 100%, so you're worth even more.
Yeah.
Now this is an example again though of Tesla with only a 1-year time horizon, not 5 years. So if you bought it beginning of the year in January, it's actually would have been way lower. You would have been in negatives. And then now just breaking even. So if I had invested at the beginning of the year, it's not 5 years ago, I would have basically broke even, like maybe 10-15% above. So my $10,000 would only be worth, $11,000. Yeah. So it just depends on what kind of risks you want to take. Okay. Let's skip ahead to other growth investing opportunities. There's many of them. Here's just a few to be listed. You can do day trading, which is like you buy a little bit every day, and you try to sell it, whenever it starts to go down. You try to buy it when it's going green and going up before everybody else gets in. And yeah, you keep doing that daily. You can lose a lot of money that way, though, so I don't recommend it. They have what's called wheel trading, where you buy options and you sell options. And options is what I'm actually invested in right now, but I don't do the options. It's all done by a fund manager, and they call them either covered call options or put options. So, but I usually generally buy covered call funds. So more into that in a bit. Then you can do target trading, where you buy a fund and you wait as long as it takes until it gets up to 20% growth, and then you sell it, and then you take that money and you reinvest into something else. Let's just say, for instance, you take 1% of all of your money and you put it into 100 companies. 1%, so you have 100 companies. And then over time, whenever any of those 1% of those companies, any of those companies reaches 20% growth, then you turn around and sell it and you reinvest in something else. And you just keep on waiting until they grow. So for some people who do that, you can buy into futures, you can buy into crypto, et cetera, et cetera. So there's lots of opportunities to research and learn about those yourself, though, because income investing overview. This is more of what I'm interested in doing because I am getting close to the time where I want to become financially free. I want to be able to do my own thing. I don't want to have to be working anymore. And so right now I am testing income investing, which has been quite fun so far. It can be a little more stable and it can be a little more scary depending on, like, it's scary at first because you don't really know what you're doing. You're putting your money into something and you're trying it out. And I tested it for a year and I found it was working quite well. So then I ended up selling my house and reinvesting the proceeds of my house into it as well so that I could reach financial freedom sooner. And the goal of income investing, generally speaking, is to replace your actual monthly paycheck, right? So in this case, we have several different avenues. We can go with high interest savings accounts, but you need a lot of money because high interest savings accounts will only probably pay you, I think, around 1% to 2% right now this year. A couple years ago, it was around 3 or 4%, so that was a little better. Then you have bonds and GICs. You have dividend stocks. You have covered call funds, and then you have BDCs, which are business development companies. We'll talk about more of those in the following slides. So, first off, we have bonds and GICs. So bonds and GICs, you're probably familiar with these. When you go in and you talk to your financial advisor, he'll ask you what your risk profile is, and he'll ask you, so how much risk are you willing to take? If you have a longer time frame or longer time horizon, say you're only like 20, 30 years old, you may have a higher risk tolerance. You're willing to let your money work for you and maybe lose a little bit and grow a little bit over time. And over time, it generally will grow. So when I first talked to my financial advisor, I just said, yeah, I'm happy with 60-40. So 60-40 risk and 40% non-risk. So they put 60% of my income that I had into basically equities. They call them equities, which is the stock market. And so it's just individual companies, and those will grow over time. And then the other 40% was put into bonds and GICs, which are the non-risky version. They are basically locked in for a certain amount of time. You can buy a GIC or a bond, and you can say, oh, you know what, I need 5% return, and they'll say, okay, well, in order to get a 5% return, you have to put this amount of money, like you have to put the money in with us for a minimum of 5 years or 1 year or whatever the bank says. And then those type of funds, they're ideal for stability and predictable income. If you have, maybe a pension and social securities, and you have some money saved up from a house that you sold, well then living off of your GICs might just be enough to live off of. It's not a very high return, maybe 3 to 5%. When I looked online to do some research, it's about the 20-25% average. The 20-25 average is 3 to 5% returns right now on GICs. So then we have what's called dividend investing, and that is where you pick. Remember how I told you we have like growth companies, and then we have so we have startup companies who are definitely, they're poised for growth. I'm not going to say they're destined for growth, but let's just say that we knew that Palantir 2 years ago was a great company. We would invest in that. That company is so small, it does not offer dividends. And a lot of tech companies, even today, like Microsoft and Apple and stuff, they don't offer dividends because they offer growth instead. Like their company continually reinvests any profits it makes back into the company itself to help make it grow further. Whereas some of the larger companies that, like let's say for example, Coca-Cola has been around for 100 years, TD Bank's been around for 100 years. There's still growth enabled in them because they're still making money, but they're not going to make 100 times returns. So in order for them to like garner investors to come to them, then they actually they offer dividends. So they'll say, listen, out of a portion of our profits, we're going to give you, such and such amount of money per quarter. So every 4 times a year, they'll give you a small dividend. And over a year, you could make between 3 to 6% on one of these dividends. So it's not a lot, but if you get a basket of companies, over time, it's a very stable return, and it's a little more than GICs and bonds. So you get a dividend yield of 3 to 6%, plus you also have the growth potential of that company. So, TD Bank's been growing forever, and so it's going to continue growing. It might grow for another 5% this year or 10% this year. So on top of that, you could have maybe 10 to 15% total return. 3 to 6 with the dividend yield and 5 to 10 with the growth potential. So finally, or not finally, but another option that I'm currently investing myself in, covered call investing. Now, there are great videos out on the internet that explain how these funds actually work, like to get the technical details and stuff. But all you really need to know is that they take a portion of the fund or the whole fund, and then they write a certain amount of options on it, and they can make a premium off of every time they sell an option. And so those premiums, people will buy the premiums and people will sell the premiums, and it's kind of like a whole market in its own. And they can actually make a fairly decent return on those, typically between 6 to 20% annually. So that's much higher than the dividends. The higher yields you can create even higher yields with leverage, which is good. But if you pick a poor covered call fund, they may be paying out more money than they actually make, and so your initial investment, which they call NAV, can slowly decay over time, or the price of the fund can slowly decay over time because they're paying more than they're actually earning in income. So those are a couple things you need to be aware of. So here's a quick summary of the different types of funds if you want to pause it and take a look and see which one might fit best for you. Now, I want to kind of explain why I'm not going growth investing and why I'm more going income investing. And this is not always for everybody. So, but I want to explain. So, growth investing is kind of like, if I can use the analogy of real estate. When you invest in a house, when you purchase a house, if you buy in the right market, then you could see your house double in price. A friend of mine, he bought a property in Toronto, and when you bought a property in Toronto for $400,000, and then in 10 years' time, it's now worth $800,000. He doubled his property value, and his investment is now doubled. But for myself, I bought a property in Edmonton for $400,000. And I bought it in 2014, and then in 2024, beginning of the year, it was still worth the same amount of money as what I paid for it. So there was no capital appreciation there. So it totally depends on the market. You can't make any income until you sell the property, so there's that as well. Like, you can live in it in the meantime, or potentially you can even rent it. Like, maybe you can get a little bit of both. But you may be forced to sell at a loss also if you need to liquidate in a low market. So with renting, or with a with a growth property, you may be forced to sell it while the market is low. I was lucky when I finally sold my property in 2024 that the house, like the end of 2024, the real estate market had gone up enough that I was able to break even when I sold it to cover all of the upgrades and the extra add-ons that I had built into it. So I was happy to walk away from an even win kind of thing, right? So with income investing, though, it's kind of more like owning a rental property, because you're relying on a steady cash flow. You're not relying on price gains. So for me, if I buy a covered call fund, I don't really care if it goes up or down that much. I definitely want to make sure I buy one with a strong underlying stock, or a stock of fund basket of funds, but I do want to see monthly income that stays consistent, so that it's like my paycheck. I don't have to worry about not making a payment on my rent or whatever. The other good thing about income investing is that your income will continue even if the property value stays flat. So for me, I don't care if as long as I don't sell it, it doesn't matter if it goes up or down. Let me rephrase that. I don't mind if it goes down temporarily. If it continues to go down, I will sell it. And I have had some, when I first started learning how to invest in covered call funds that have gone down, and I've had to drop and I've had losses on. So I will show you another video on how I choose a good fund and how to, there's always a chance they can go bad, but if you look at their track record and their history, I'll be able to show you more on how that works in another video. So with income investing, you don't have to ever sell. Now, a couple other considerations with rental properties, though, that are bad, is that you could have bad renters. They can destroy your investment. You may need to sell or remortgage the property if you need capital. Or what happens if, for some reason, you have a health issue? All of a sudden, you need $50,000, $60,000, or you need to do a reno because you just found out the basement's full of mold, or there's a flood, or something happens and your insurance doesn't cover it. You may have to, all of a sudden, all of your current gains are lost. You're always on 24-hour call maintenance. So again, if that fridge fails or if something happens to your clients that they're not happy, the tenant that they're not happy with something, you got to go over and take care of it. And then when the tenant decides to leave, you may have to go in and repaint or fix the flooring or do certain upgrades or whatever while there's nobody living there. And that means that your property is sitting empty while you're trying to find a new tenant to fill the to pay for your mortgage and your rent. And losing 1 month or even 2 months basically means you've broken even or lost money for the year. With income investing, there's a couple considerations. One, your underlying investment could appreciate faster than the covered call fund will allow. That means dividends doesn't matter, but covered call funds, because they sell options, they can be capped. And so if the underlying fund grows very quickly, like say Tesla all of a sudden gets some really good news and it shoots up so that it gains 10% a day, the covered call might cap you at 5% earnings, and therefore you can't make that extra 5%. So ideally you want to invest in companies who don't jump 10% or 20% in a day and then drop 20% in a day. Those are things that I've learned over time. One of the pros of income investing is that you don't have tenants, no maintenance, you're always producing income, and you can sell it anytime you need it. Okay, I think I basically just talked about some of this, but the lessons I've learned is that a lot of the American covered call funds are generally selling options on 100% of the covered call portfolio, and they get really high yields. You'll look at some of them and they'll say 30% return or 50%. I've even seen some 86% return. But after you notice that their fund NAV, or the price, continues to drop month over month over month, you realize that they can never recover all of the money. If a fund grows quickly, they're capped, and they can never regain all of that capped income. So a lot of the American ones, when they're using the 100% covered portfolios, they lose money over time. The one nice thing about a volatile market or a volatile stock is that they can give you more premium. So they do have that going for them. You can make a little bit more money versus a slow and steady boring fund. Canadian covered call funds, you'll have to look at the prospectus on most of these funds in Canada, but most of the funds will say they'll sell options on 30 to 50% of the fund, and then the other 50% of the fund is actually still allowed to grow naturally. So it can never be capped. The other half of the fund can never be capped. Many Canadian providers also offer covered call leveraged ETFs, which can even enhance your growth further. So I'll show you some examples here in the next screen. And I'm sorry if this video is a little bit long, guys, but I just kind of want to give you some of the basics so you can understand why we're doing this, and so hopefully it does make sense. So here is an example of Tesla. Okay, Tesla is this fund right here in red. And if you had bought it with $10,000 over time, let's say $1,000 over time, it went up 98% over time. So your fund, this is over how long? 1 year. 1 year time frame, it went up 98%. But if you had bought the Tesla covered call fund, Tesla from Yieldmax, it would have gone up a little bit, and then right about here it dropped below your initial $10,000 or $1,000 investment, and now you're running at about minus 26. So your initial $1,000 might only be worth $800. So this chart, I'm only showing you the growth. I'm not showing you the total returns. The actual monthly income is not being added to this. I'm just showing you how the fund has performed. If I was retired and living off it and using all of the investments, I'd be losing money over time. So I just wanted to show you that. If I had bought a Tesla and I was retired, I still couldn't use any of these funds because it's tied up in the fund itself, right? So, and what happens if I had bought it? Let's just say this is a 5-year term. What happens if I had put all my investments in here and I didn't sell it here? I kept on holding it, and then this is the year I had to retire. Well, all of a sudden, my income is the same as what I put it in 2 years ago or 5 years ago. So I can't retire now because I basically just wasted the last 2 years of my life. The income hasn't done anything. I would have been better just to hold it in something else and then reinvest it here and then let it grow. You know what I mean? That's the downside of investing in a single stock or even a growth investment. In a sense, it can go up or it can go down. So you have to make sure that you buy something like, here's the S&P 500, 500 top stocks. So over time, it slowly grows. And if this keeps paying me fund, if this is the covered call investment that I'm invested in, every month it's growing no matter what, and I get a payment every month, that is good. Because I know that my initial investment of $10,000 over here is going to be worth, 14% more after a year. Okay, so here is an example of S&P 500 in red. So if I had to put all my money 2 years ago in the S&P 500, it would be worth 50%. It has grown 50% over that period of time. Now, if I had put the money into a covered call fund, and this is not including distributions, this is only just the growth of the fund. The fund itself has followed the S&P 500. It hasn't grown quite as quickly as the S&P 500, but this particular fund, USCL, which is the Global X, has these funds in their portfolio. You can see that both of these funds are positive. So my initial investment has grown, but it hasn't grown by nearly as much as the S&P 500 has grown over the same period of time. Now, this is without dividends reinvested. So imagine this is me living off of the distributions. So let's just say I had $100,000 in this fund, and it was paying me $1,000 a month. So I'd be happy to invest in this because over 1 year's period of time, I haven't lost my initial investment. My actual initial investment has grown 15% over the whole year. And I'm able to spend all of my $1,000 a month distribution on whatever expenses I need to pay to live off. So that's my financial freedom. Now we'll go check a chart out that shows that if I wasn't living off the income and I was reinvesting it. So if I was to drip, they call it drip, but if I was to reinvest every distribution that they gave me, then you can see that the S&P 500 is still 51% growth over the whole year, but 2 years, but USCC, the non-leveraged version of the fund, has gained almost exactly the same as the S&P 500, so that's very good that it's matched it. And then you can see that USCL, the leveraged version, is almost 60% increase over the same period of time. So if I had have invested $100,000 into each of these three funds, it shows me that USCL would have made the most amount of money for me. Isn't that interesting? Because a lot of people are like, oh, growth funds are better. And if you get the right growth fund, yes, it can be better. This S&P 500 is kind of the gold standard for what we would consider general growth. Like Warren Buffett, he said that if you don't know anything about investing, you're better off to at least just put your money into the S&P 500 and let it grow for as long as you need it to grow. Generally speaking, the S&P 500 will return between 7 and 8% per year. Some years it's going to be way better. Like this year, you saw, I don't know if you saw, but it's about 15% this year. Whereas maybe in a bear market, a recession or something like that, well, then you could be negative a little bit, but again, it will grow. So hopefully that kind of makes sense with growth versus covered call income. So if you buy the right covered call fund, it can actually outperform the gold standard or the S&P 500. So this is a cool comparison tool that you can find online that actually shows you how much your income would be with your dividends reinvested. Just want to show you real quick down here. Many online charts, they actually don't take into account the monthly compounding from reinvesting your distributions. They call that drip in most financial institutions. So what most charts will do when you go and look at, say, Yahoo Finance or TradingView or whatever, they basically look at the total growth over that period of time, and then they add the total distributions to the total growth, and that is your total return. But this channel, this chart right here, actually shows you the snowball effect that comes from buying every month that will not be always apparent in many of these online tools. So if I'm buying every month, then every month my income, my value of my fund is going to be a little bit higher than the last month because I'm continually buying it, and the snowball continually compounds and grows. So this just kind of shows you a quick example. This is a cool tool because it shows if I'm retired or if I'm living financially free. If I want to live, if I put $10,000 into something and I don't invest my dividends, here I put my $10,000 in. At the end of the investment, it's worth $11,806. So I have been able to take out my distributions, plus it's still greater than what the S&P 500 was over the same time period. The S&P 500 does not give you, I mean, it gives you a very, very small dividend, like maybe every 3 months, but it's not enough to live on unless you have a lot of money in the S&P 500. So this shows me that the USCC, I can actually, my initial income will grow, plus I can still live off the dividends. Here's USCL, which is the leverage version. So it's a little bit higher. Like I made maybe $300 more, with the $10,000 investment. So you can see, you can multiply that to see more. And you can just look at the charts here to say that they both match, and you can actually get a little bit more money growth through the leverage version over time. The top one is just so right now I'm not retired, I am still working, and so for right now I'm just putting drip on everything, and you can see that the leverage version, I don't own this stock, but if I did own the stock, then it would be almost $500 higher than if I was investing in the S&P 500 over the last, this is a full year. from October to October. Okay, well, that was a long video, but I hope that you gained some valuable information from it, maybe made you thinking a little bit more about investing. Warren Buffett says that the best investment you can make is in yourself. So educating yourself, learning a little bit through this video and maybe other videos on YouTube, hopefully will make you a better investor. But there's nothing like actually putting your money to work and testing and learning on your own. Don't just copy anybody who's online just because you think that they might know a little more than you. Everybody's investment journeys and goals are a little bit different. For me, my goal is to potentially gain financial freedom fairly quickly, and once I reach that, then I don't need to work any longer. But somebody else who maybe has house mortgages or other financial not challenges, but responsibilities, then they need to manage those first. Like, you definitely want to try to get out of debt before you start investing, just because the interest on your debt is probably going to be more than you'll make on the interest on your income. So things like that you have to think about. It's called The Richest Man in Babylon, and I think that would be the best video to watch at the very beginning. So if you haven't watched it yet, check out that one. But in the meantime, keep learning, be patient, stay consistent. And if you have any questions, feel free to put those in the comments section below. And thanks for taking the time to watch this video. I hope it helped.